Okay, hi everyone. So today's session, as you know, will be, you're watching the video now, I'll be going through covering some more fiscal policy material and then shifting into exchange rates. But before I get into the material, I just want to go through a few administrative things. So first, Laura will be sending out more information today about office hours and TA sessions, including Zoom links. Another thing is the last problem on problem set 6, which is on international trade, is not due this week in section. I'll be covering that material probably on Thursday, so there won't be enough time for you to incorporate that into your problem set. But we'll be uploading the solutions for that. We will be uploading later today a previous final exam from either 2019 or 2018 winter when I taught, and then we'll be uploading a second final exam, whichever the other of those two, later this week, probably Thursday or Friday. You will be able to upload your problem set on later this week to Canvas, and we'll have lots of guidance about how to upload your final exam. So more information will be forthcoming soon about the final and the timing and so forth, but we'll also be sharing information about a review session. So with that, I want to go over a couple of things that we went over last time, partly because of changes that have happened in markets since we last met. So when we last met, we were covering the decline in interest rates, the sort of, and basically, if you, we showed the yield curve for the first few days of January, February, and March, and saw how much things had changed over time. And I've focused, I think, the discussion then on what had happened to the 10-year rate, which had fallen from 1.88 down by the time we classed down to, let's say, 1%. And it's fallen even further since then. So interest rates right now are literally at their lowest ever level, the interest rates on Treasury securities. So 0.54 percentage points for the 10-year security, less than a percentage point, 0.99 percentage points for the 30-year. And basically the yield curve right now is pretty flat. By the yield curve, I mean what is the interest rate on the vertical axis and the length of time on the horizontal axis. In general, the yield curve typically tends to slope up because investors need to be compensated for the risk of higher inflation that can happen over the subsequent years. So, and I showed you a yield curve from a few years ago last time that conformed to that prediction, that basically interest rates on, let's say, the 1 month or the 3 month or the 1 year were much lower than on the 10-year or the 30-year. And right now, though, there's basically this flight to safety by investors, as investors have been pulling out of stocks, also known as equities, and flooding the bond market, putting that money into the bond market, which has tended to raise the price for bonds, and the interest rate moves in the opposite direction of the price of bonds. So as the price for bond goes up, the effective interest rates are falling. And this really is it is incredible how low interest rates have gone. And as you can see, basically all of these interest rates are below 1%. And just to get a sense of how much it's changed over a relatively short period of time, here I show the figure. This is taken from the Wall Street Journal yesterday, looking at Treasury yields over the past year. So if you look about a year ago, the interest rate, so there are two different securities here, the 30-year and the 10-year. You can see basically throughout the period, the 30-year has a higher interest rate than the 10-year. Partly for that reason that I mentioned about the compensation for the greater risk associated with what will happen to inflation over a 30-year period versus just a 10-year period. But as you can see, back in about a year ago, the interest rate for 30-year Treasury security was about 3%, and for the 10-year Treasury security was about 2.5%, so a wedge of about a half percentage point. And both of those drifted down pretty steadily over the subsequent 11 months, basically sort of like this, and the gap between them remained roughly constant over that time period. But as you can see, over the last couple of weeks, both of them have fallen very dramatically. And that is, this rate right here for the 10-year and for the 30-year, it's literally the lowest ever rate in the time that we've been, for which we have the data. So decades and decades, this is lower than it's ever been. So I guess one silver lining to this is that it will cost the government less if interest rates remain this low to borrow. It'll cost the federal government less to borrow, and that will tend to lower the deficit. But it will, it is also, it's partly a sign of the economic turbulence right now that there has been this dramatic decline in the stock market, almost a 20% decline from its height. And so this partly is a symptom of economic weakness, the lower interest rates. And chances are that they will start to go back up. Just even this morning, I saw that the 10-year had started to go up somewhat, and it's hard to predict exactly where those will end up. So as you can see, that this and the title of this article in yesterday's Wall Street Journal was "Investors Rush into Bonds to Shelter from the Market Storm." So yesterday, the stock market, the stock market fell by almost 8%, which is a very large change in the course of just one day, and it's one of the biggest declines ever. So preliminary data, if I just look right now at how the markets so far are doing today, we can see this. If I just go to wallstreetjournal.com, and you can see that the market is up a little bit, 0.64%. The Dow is up, and the S&P is up 0.9%. So that doesn't make up for the full 8 percentage point decline. You can also see the 10-year yield is up to 0.64%, which is higher than it was than it closed yesterday at 0.54%. Okay, so. And I also spoke a little bit last time about the importance of automatic stabilizers. So one challenge of using fiscal policy to combat economic weakness is that there can be a lag in deciding what form of stimulus to implement and a lag in getting the dollars out. And I talked a little bit about a tax rebate back in 2008 that was distributed to taxpayers, and they actually did it over a 10-week period. They staggered when people received the tax rebates based on the last digit of their Social Security number. But it took some time, and that was considered to be relatively quick, but it took some time to make those decisions and to get the money out. And there's something called automatic stabilizers that we've talked about before that partially address this concern, this lag, and they sort of somewhat more quickly can help cushion the effects of an economic downturn. So one important automatic stabilizer is the progressive tax code that we have. And so if you look at low income levels, the interest rate is 10%, and then it goes up to 12%, and then there are a number of other rates until it peaks at 35%. Okay, so if my income is very high and I have a marginal tax rate of 35%, but then I lose my job, my income will fall, and my average tax rate will then be much lower. Maybe it'll be, if I had half of my income taxed at 10% and half taxed at 12%, it would only be an 11% effective tax rate. So this progressive tax code basically means that you get to keep a larger share of your income as income falls. And so that will serve to cushion somewhat the effects of any economic downturn. Second, very important automatic stabilizer is unemployment insurance. And it is this provides cash to more households as the unemployment rate rises. And we, as I've mentioned in previous classes, the unemployment rate right now in the US is at historically low levels. And we just had a jobs report, I think on Friday last week, and it was a really strong jobs report. If I recall correctly, there was evidence of about 275,000 additional jobs and the unemployment rate was down to about 3.5%. And so this jobs report is released the first Friday of each month, and it's based on a survey that takes place the middle of the previous month. So mid-February, the U.S. job market was very healthy, strong job growth, reduction in unemployment, but it's possible, given the economic weakness right now caused by the coronavirus and some other changes that are happening globally, that we'll start to see a rise in the unemployment rate. And if that were to happen, if companies started laying off workers, they could very soon thereafter go to their local unemployment insurance office, sign up for benefits as they're searching for a job, and that provides more cash to more households as the unemployment rate rises. And it's very quick, because as soon as a person loses their job, they can go apply for unemployment insurance benefits. I believe there's typically at least a week between when you finish your job and when unemployment insurance benefits start, but still that is quite quick relative to waiting for Congress to decide on something and then putting the wheels in motion to actually get the money in the hands of people. Another automatic stabilizer is food stamps. So this is a program that if you have a sufficiently low income, then you can qualify for essentially funds from the food stamp program. These funds can be used only for qualified expenses, so they can be used for getting groceries. Suppose you wanted to get like milk and bread and other food items, that would be covered by food stamps. It would not you couldn't use it to pay your rent or to pay your utility bill, but this is a program that is quite large. It grew from 26 million in 2007 before the Great Recession to 48 million by 2013. And it's actually a program where enrollment grew and didn't come down quickly after we were out of recession. Enrollment remained high for many years. As you can see, 48 million. By 2013, we were well out of the recession, and yet enrollment in the program was still high because many people, their incomes remained low for long after even employment started to pick up. But all three of these automatic stabilizers were further expanded by policy changes that happened during the Great Recession. So there were some tax cuts that were implemented as a part of the stimulus package that I mentioned last time. There were increases in food stamp benefits that were a part of the American Recovery and Reinvestment Act. And also the maximum duration of unemployment insurance was extended from 26 weeks, which it typically is during regular economic times, to 99 weeks. So and part of the rationale for this was that employment was declining by so much. If someone lost their job, there just weren't jobs available for many people. And so it wasn't, part of the reason for having a relatively short maximum duration of 26 weeks is so that people are hungry to get back to work and not continue to receive benefits for too long. But this was extended to 99 weeks, recognizing that for a lot of people, even no matter how hard they looked, there wasn't going to be a job available. And so this brings me to one of the readings that is on your syllabus that you're responsible for on the final, and I think it's an interesting article that looks at the acceleration in the U.S. economy. So this is from about 16 months ago, this article, October of 2018, and it makes the point, we remember that sort of GDP is some of these components, the demand components, consumption, investment, government spending, and net exports. This article makes the point that government spending, G, is a big reason that the U.S. economy was accelerating in late 2018. And this was right around the time that Federal Reserve Chair Jerome Powell said that the economy was doing really well. This was a time of a lot of strength. And you can see that in the years from 2009 to 2017, defense spending actually was falling by 2% per year on average between June 2009 and March 2017. But that flipped from declining at a 2% annual rate to growing at a 3% annual rate beginning in April 2017. And this turnaround alone, just this one part of federal government spending, added 0.21 percentage points to the nation's overall economic growth rate. So this is, an example of how the fiscal policy, in this case government spending, through defense contracting can be a contributor to faster economic growth. There's a potential cost associated with this, though, which is that if we raise spending too much and it increases the deficit, that an increase in the deficit is likely to raise interest rates. So all else equal, if we go from, let's say, a $500 billion deficit to a $900 billion deficit, that basically represents a shift in the demand for loanable funds. So you can think about the market for loanable funds here and an interest rate serving as the price. We're initially, let's say, at this equilibrium right here with D0. This is supply of loanable funds. And essentially, if the government starts borrowing more money, that represents sort of a shift from D0 to D1 that is likely to raise interest rates. And this can offset part of the stimulus from a tax cut or a spending increase. So when spending on defense goods was going up, this may have increased the deficit and thereby increased rates. But as I mentioned earlier, for other reasons, all else isn't equal right now, and that's why even though we have a high deficit, we've got low interest rates. One of the challenges for fiscal policy, so if we have stimulative fiscal policy, either a cut in taxes or an increase in spending, that is going to tend to raise the deficit, which may increase interest rates and thereby crowd out some private investment and possibly consumption. So that's one challenge for fiscal policy. You may get an extra chunk of spending here, but that may cost you in terms of its effects on other components of aggregate demand. It's also very difficult to get the timing right. So it takes time for policymakers to recognize that the economy isn't doing well. Then Congress, there's legislative lag as Congress debates what to do. And then finally, there's implementation lag. Even once Congress has decided on whether to cut taxes or raise spending, it's going to take time for this to get implemented. It's also, so that's another challenge. It's difficult to get the timing right. Maybe by the time the money comes through, the economy is already recovering and it's going to cause GDP to overshoot potential by more than it otherwise would. It's also very difficult to get the right amount of stimulus. And this was a huge debate during the early days of the Obama administration. Should there be no stimulus, American Recovery and Reinvestment Act? Should it be $800 billion, which is about what it was? Should it be $1.2, $1.4 trillion, much bigger? That was what my then boss, Christina Romer at the Council of Economic Advisors, was arguing for, a bigger, more aggressive stimulus. And it's hard to get the right amount because it's hard to know, for example, what amount of a tax cut will consumers spend, or how responsive will firms be to an investment tax credit which tries to increase their incentive for investment. So it's hard to get that right. And then this is, you can sort of think of these as different challenges here. I'll put numbers on them. 3. And then 4, temporary changes may have little impact. So a tax rebate, if basically we send a check to every person in the US for $1,000, people may realize that this is a one-time thing and may decide to put it in the bank and draw it down slowly. And so they may, for example, opt to save most or all of a tax rebate. And so these represent important challenges for fiscal policy, and it is, if output overshoots potential, then inflation is likely to result. It's also the case that as we adjust, as the economy is churning through, if we have a lot of employment loss, that there's going to be an adjustment process that's slow as workers get retrained and potentially shift to other jobs. And then I asked all of you to review this reading, the case for a big coronavirus stimulus. This was in the Wall Street Journal last week, and it was written by Jason Furman, who a number of you had lunch with when he was on campus a few weeks ago. He is the former chair of President Obama's Council of Economic Advisors. He's currently a professor of the practice at Harvard University. But he makes a case, and this is even before the downturn yesterday, for trying to do something big to offset the economic downturn that we may appear to be heading into. Given the mounting economic risks posed by the spread of the novel coronavirus, Congress should act swiftly but thoughtfully to pass fiscal stimulus. So, and a number of the principles that we've talked about previously are present in this article. So, for example, accelerated. It makes the point that it takes a year or more for monetary policy to have its maximum economic impact. Last week, we saw that the Federal Reserve cut interest rates by 0.5 percentage point, and that was a big change. But Jason Furman is arguing that that's going to take time to have its effect. Also, it should be big, given the large amount of uncertainty around the virus. That it should be something that really gets people's attention. If it's only like $50 per taxpayer, it's not going to have much of an impact. It should be comprehensive, and this is his proposal, that it should strengthen the social safety net to differentially benefit basically people with lower incomes. And then finally, it should be dynamic and contingent on economic conditions. For example, if the economy starts to recover quickly, maybe scale it back, whereas if the economy starts to go further and further in, then perhaps increase it, and especially in the hardest hit areas. If we are about to enter an economic downturn, there will be heterogeneity across geographic areas with respect to the magnitude of the hit. So this is a really interesting article, and I thought it was, it's just an example of how many of these concepts that we've been covering in Econ 1 are hugely relevant right now, given the challenges that the US specifically and the global, more generally, economy are having. Okay. So next I'm going to conclude the fiscal policy section talking about the key challenge that exists here in the US, and it is not unique to the US. Basically all industrialized countries, Italy, Japan, Australia, Germany, and so forth, have big challenges coming from changing demographics. And they pose a really massive challenge for us as a society. Basically, there are two factors that are driving the major changes over the next 20 years. One is the aging of the baby boom population, and this is defined as individuals who were born from 1946 to 1964. And then second challenge is rising life expectancy. So a number of programs, people become eligible for them at a specific age. In the case of Social Security, people can start collecting Social Security retirement benefits at the age of 62. Many people take them then or soon after that. Also, people qualify for health insurance through the Medicare program at age 65. And so as people live longer beyond their 62nd birthday or their 65th birthday, they are going to be receiving benefits from Social Security and Medicare for more years. And that just becomes more challenging to finance. And you can get a sense for this if you look at population projections for two main age groups. Let's contrast non-elderly adults who are 18 to 64 with the population 65 and up, and look at what are the projections for how those two populations will change over the next 15 or 20 years. And the most recent population projection data uses as its baseline a population of 200 million non-elderly adults in 2016 and 49 million 65 and up. So you basically have about 4.1 non-elderly adults for every elderly adult in the US in 2016, 4 years ago. And if you look, the projections from the US Census Bureau are that the number of non-elderly adults will increase by just 5% over this period, from 200.2 million to 210.2 million. So that is a relatively small increase when compared with the corresponding increase for 65-year-olds from 49 million to 78 million, an increase of 59% for people 65 and up versus only 5% for people 18 to 64. As a result of that demographic change, we'll see the number of non-elderly adults per elderly adult fall from 4.1 to 2.7. And that's a challenge because elderly individuals tend to receive benefits from the government. Non-elderly adults tend to pay the taxes to finance them, but there's going to be a growing imbalance between the amount of tax revenue that is coming in and the amount of benefits that are being paid out. And that's going to create a fiscal challenge and will tend to raise deficits. So 4.1 in 2016 versus just 2.7 in 2035 The further out you go, the harder it is to make these projections because many things start to matter. How are mortality rates going to change in the future? How are birth rates going to change in the future? What's going to happen to immigration policy? But the projection is that if you use the Census Bureau, 2060 is the furthest out that the Census Bureau goes. And in that year, the ratio of non-elderly adults to elderly adults is about 2.4. So most of the change is going to happen between now and 2035. And this will very substantially increase spending on entitlement programs like Social Security and Medicare. And either taxes will have to increase to finance that growing demand, or spending on these programs or on other services will have to fall. Okay. And this is a big, this is a challenge that one of the, and many policymakers, you will hear them say that we should reform Social Security and Medicare now so that we're not hit with a crisis in 15 years from now in 2035. But it's very difficult, given the way politics works, to get people focused on a problem that is big but far out. It's not immediate. And so, unfortunately, the longer that we wait to address the projected imbalance between tax revenue and spending, the more painful the adjustment is going to need to be. It will either need to be a bigger tax increase or a bigger cut to benefits, or some combination of the two. Okay, so one of the things that makes all of this somewhat difficult is we have to make projections about things like mortality rates and birth rates. So I'm going to give you some recent data on both birth rates and mortality rates, and these inform the projections that the Census Bureau makes. And so some quite striking changes. First, in the birth rate, let's look at what was happening to this. If you look, let's say, from the mid-1990s to the mid-2000s, from like 2007, you can see that the birth rate in the US was increasing over time. Okay, it was increasing, and I'm looking at the rate as opposed to the number because I want to denominate by changes in the number of women. This is looking at number of births, I believe, per 1,000 women aged 15 to 44. Okay? And so you can see that rate was increasing pretty steadily for about a decade, but since 2007, the birth rate has fallen quite substantially. And a number of people at the time when this started to fall chalked it up to the effects of the economic downturn. You may recall that we entered sort of the Great Recession started in 2007. So as people's economic well-being declined, they became less likely to have children. That was one of the hypotheses for this decline. But that hypothesis was that as the economy picked back up, this birth rate would start to recover. And that has not been the case. So the birth rate has continued to decline. And so if you're trying to project, let's say, what's going to happen to the number of people 18 to 64 by, let's say, 2060, you need to know you need to make a prediction about what's going to happen to the birth rate over time. And this figure just kind of underscores that it's difficult to predict. If you'd asked someone back in 2005, how would birth rates evolve in the US, you wouldn't, I think very few people would have predicted the decline as large as we've seen. And it's interesting, though, because this is just one overall trend for women aged 15 to 44. You get a very different picture as you sort of look more granular and by different age groups. And I want to call your attention to a couple of differences here. So if you look back in 1990, when I was an undergraduate, you can see that at that time, the birth rate among women 15 to 19 was actually about twice as large as the birth rate among women 35 to 39. So that's where things stood back in 1990. And what you can see is that in the years since 1990, the birth rate among females 15 to 19 has steadily fallen, whereas the birth rate among women 35 to 39 has actually risen. And so it is now the case that women 35 to 39 are about almost 3 times as likely as females 15 to 19 to have kids. And this is, a really big change over this period, you can see in general, you tend to see increasing birth rates for women 30 to 34, 35 to 39, and 40 to 44, versus reductions for birth rates at age 15 to 19, at age 20 to 24, and somewhat at age 25 to 29. So there are big differences by age, and some of this is attributable to greater educational attainment among women who are staying in college for longer. So this is an article taken from the Wall Street Journal about 10 months ago that says the number of babies born in the US last year fell to a 32-year low, deepening a fertility slump that is reshaping America's future workforce. So as there are fewer babies born, that means fewer people entering, let's say, the workforce 20 years from now. And what you can see, the general fertility rate, the number of births per 1,000 women ages 15 to 44, fell to 59, the lowest rate since the start of federal record keeping. And many demographers had believed that births would rebound as the economy recovered, but that trend has not materialized. And there are a number of trends that appear to be behind this change. For example, teenagers and unmarried women having fewer kids, lower Hispanic fertility rates, and the rise in women obtaining college degrees. But as you can see, basically the number of births that the average woman, the number of children that the average woman has is declining from what is sometimes referred to as a replacement level of 2.1 down to about 1.7. So demographers estimate that for the population to stay constant, if there's no immigration, then the average woman would need to have about 2.1 kids over her lifetime, and we're down to about 1.7 at this point. So that's one part of changing demographics on the horizon. What happens to birth rates? So this matters somewhat less for the 2035 projection, but more for projections beyond 2035. Then also, another thing, I mentioned that there has been a steady increase in US life expectancy, and that has increased the stress, the strain on programs like Social Security and Medicare, because instead of receiving the benefits for 5 or 10 years, as they did in the past, today's elderly are likely to receive the benefits for 15, 20, or 25 years. And so that means that it is bigger demands on the program. And this rise in life expectancy is pretty remarkable. If you look at the life expectancy at birth and how that has evolved over time, it has increased really steadily since, for decades. So if you look back in 1940, the life expectancy was just 63 years old. It increased to 68 years old. 10 years later, it increased to 70. 10 years after that, to 71. 10 years after that, to 74 in 1980, 75 in 1990, and to 77 by 2000, and then all the way up to 79 by 2010. Okay, that's the increase in life expectancy. So Social Security was actually created in 1935, back when life expectancy was only 63, and the sense was that people were going to receive the benefits for a relatively short period of time. But as you can see, the life expectancy grew from 1940 at 63 to 79. That's a 16-year increase, okay, over that 70-year period. So more than an average of 2 years per decade in terms of an increase in life expectancy. But that increase has recently stalled. So if you look from 2010 to 2017, actually, if anything, life expectancy has fallen somewhat from 78.7 to 78.6, and that is a big change in the in sort of the demographics of the country. But this is driven less by declines in mortality rates for older individuals. So what this figure shows is on the horizontal axis is year, and on the vertical axis is the birth rate. And it's done on a log scale so that the jump from 100 to 1,000 is the same as the jump from 1,000 to 10,000. And basically it disaggregates the population into about 10 categories, including 85 and over and 35 to 44 and so forth. But looks over a very long time period, and you can see, like, let's take 65 to 74-year-old men. Their mortality rate has declined a lot over time. Infant mortality, as I talked about in an earlier class, has declined very significantly. Okay, so in general, all of these things are declining over time, but with the recent exception of, let's say, adults age 15 to 44. If you look at men age 15 to 44, their mortality rates have actually been rising quite substantially over the last decade. And similarly, for women 15 to 44, mortality rates have been going up quite significantly over this period. And the two primary reasons for this are increases in drug overdose deaths and in the suicide rate. Both of those have, so a lot of the, even though it looks like life expectancy has stalled, doesn't necessarily affect today's Social Security program that much because the life expectancy trends that were underway for people beyond 65 seem to be continuing. So mortality rates are still falling for people 75 to 84, for example, and for 85 and up. Okay, so that is going to conclude my discussion of the fiscal policy section. And before I get into exchange rates and globalization type topics, I want to just mention that in about 10 or 15 minutes, we're going to be joined by Jonathan Coslett, who will be presenting some really interesting insights that he has on the US economy and the global economy. Okay, so with that, let me shift into talking about exchange rates and international capital flows. This is the next section on the syllabus. So if we look at the syllabus here for a second, I'll pull it up. You'll see that on the syllabus, basically exchange rate. So we just finished fiscal policy, which was for week 9, and now we're in the section on exchange rates, international trade, and so forth. That's what we're shifting to covering now. Okay, let me go back to full screen mode. Okay, great. And so exchange rates, I've alluded to this somewhat previously. Exchange rates are helpful for thinking about how currency in one country, how much of it can purchase currency in another country. So basically the exchange rate is defined as the price at which one currency can be traded for another. And there are lots of different exchange rates. There's the dollar-yen exchange rate, the dollar-yuan exchange rate, the dollar-euro exchange rate, but then there's also the euro-yen exchange rate, the yuan, British pound exchange rate, and so forth. So there are many different exchange rates, and most countries in the world have their own currency, but there are some exceptions. So some countries just use the US dollar, like Ecuador and Panama, and 17 European nations have a common currency known as the euro. And some current examples of exchange rates. So this is data as of this weekend. Actually, I think I updated this last night, so this is probably as of March 9th. So basically, $1 US can currently, the exchange rate right now is it can purchase 0.88 euros. Alternatively, a dollar could buy 103 Japanese yen, or 0.76 British pounds, or 6.95 Chinese yuan. So these exchange rates, this is just 4. There are many exchange rates, many different exchange rates, dozens of them. And if you, and trillions of dollars in currency are exchanged every day. And these transactions take place through the foreign exchange market. Exchange rates can swing sharply in relatively short periods. And it's interesting, essentially exchange rates are going to gravitate toward a purchasing power parity type exchange rate in the sense that if you can, let's say, buy one good in London for a certain amount and can buy that same good in New York City, in general, there aren't going to be huge disparities across countries in terms of, when you think of this exchange rate. So there's actually something called the Big Mac Index that gets created by the Economist magazine that looks at what it costs to buy a Big Mac in big cities throughout the world in US dollars. And there's some heterogeneity. Maybe here in the US it would be $3.50, but maybe in London it's $4.50, and maybe in somewhere else it's $3. So it's not necessarily the case that there's perfect purchasing power parity, but they usually there's some connection between the two. So who are the main customers in the foreign exchange market? There's really 4 groups. There's tourists, there's firms that export or import. Hey, Jonathan. And there's foreign direct investment. This represents, let's say, purchases of companies by foreigners. So if you think in the US, FDI that happens in the US, an example of a US company, Smithfield Foods, that was purchased by a Chinese company in 2013. This was the largest purchase ever of a US firm by a Chinese company. And that company, in order to make that transaction, supplied yuan and demanded US dollars. Whereas tourists, if you think about tourists, just going back to number one, if I'm, let's say, I'm supposed to go to Italy in June, and if I do end up going, then I would be supplying US dollars and demanding euros. If I were going to Mexico, I would supply US dollars and demand Mexican pesos. Similarly, firms that export or import are going to be consumers in the foreign exchange market. But the biggest group by a long shot is portfolio investors. So essentially people, let's say investors from the US wanting to purchase stocks in Japan or bonds from the UK and what have you. And as investors are making decisions about how to allocate their money within the US or outside of the US, those decisions about outside of the US, any expectations about future exchange rate movements are going to be very important. And one of the things that companies and individuals often do is hedge to reduce their exposure to exchange rate risk. If I buy let's say a stock in a company that is in the UK, I have two kinds of risk. First, what is the value of the stock in British pounds? But then also, how many dollars does it require to buy pounds? So sometimes people try to hedge to reduce their exposure to that risk. In terms of understanding the foreign exchange market, essentially you have foreign exchange dealers who swap one currency for another. Trillions are exchanged every day. And the first three groups that I mentioned above account for a relatively small share of the exchange that's happening in this market. Portfolio investors account for by far the most. And in general, if you look over time, you can see big changes in exchange rates. So if we look, let's say, over the last 1 year, this wasn't a huge exchange rate. A US dollar 1 year ago would purchase 6.71 yuan from China, whereas today it can purchase 6.95 yuan. So over that period, the dollar appreciated relative to the yuan. We can look over a longer time period, and here I've shown the evolution of the number of US dollars to buy 1 euro for the last 20 years, since early 1999. What you can see from this figure is that the euro hit an all-time low of 84 cents in October 2000. So that's around here. And then over the next 7.5 years, the value of the euro appreciated relative to the dollar, so that it required more dollars to purchase each euro. And as you can see, it almost doubled. Went from 0.84 US dollars to 1.59 US dollars. And so one way to think about this, if you're an investor from the US and you purchase, let's say, 100 euros, and you simply just put it under your mattress. You didn't invest it in anything, you just left it under your mattress, and then 7.5 years took out those 100 euros, you could convert it back. So you used $84 to buy those 100 euros in October of 2000. You could convert that 100 euros to $159. So you've benefited from the appreciation of the euro. And that's why an investor from the US, let's say investing in a European asset, would tend to benefit when the euro is appreciating that way. And these exchange rates affect many factors, including the relative prices of exports, of assets, and so forth. And you can basically, pretty simply, think of the effects of currency appreciation by different groups. So if I'm a US exporter, I actually am not thrilled if the dollar is getting stronger, because that means that it requires, for example, more euros to buy a dollar. That makes my goods look relatively more expensive. So a US exporting firm is not going to like a stronger US dollar, whereas a foreign firm exporting to the US is going to like a strong US dollar, because a person can buy more yen or more euros, and so that's going to make their prices look more competitive and look lower. Similarly, though, if you're a US tourist, you do like a stronger dollar, because you can buy, let's say, more Mexican pesos if you're going to Mexico as the dollar appreciates, whereas the opposite is going to be true for a foreign tourist in the US. If the dollar is appreciating, then it's going to require more of their currency to buy each dollar. And then finally, for the reasons that I just showed, a U.S. investor abroad is going to like a weaker U.S. dollar in that example that I gave, and for that reason, not so much like a stronger dollar. And so I'm just going to put up this one slide, and then I'm going to pause and hand it off to Jonathan. We can think about the supply and demand in the foreign exchange markets. Here we've got the quantity on the horizontal axis. We have the quantity of US dollars being traded for pesos, and we have what is the price of those US dollars. So you can think of it as the price as in pesos per dollar. You can think of there's a demand for this currency sloping down as it does in most markets, supply sloping up, and we may be at some equilibrium level here where the exchange rate is 10 pesos per dollar, or the quantity, but then alternatively, another way you can look at this is instead of quantity of US dollars, we can look at the quantity of pesos that are being traded for US dollars. So in this case, on the horizontal axis, I have total pesos being exchanged, and here we have dollars per peso. And so you can see that in one case, on the left, the price is 10, whereas in the other case on the right, the price is 0.1, because it takes $0.1 to buy a peso versus it requires 10 pesos to buy a dollar over to the left. So these are the two different exchange rates, and you can see the equilibrium is happening at 85 million pesos and $8.5 million in this example. And this is an example taken from OpenStax where they've got an exchange rate of 10 pesos to the US dollar. If you actually look at the actual exchange rate right now, it's about 20.66 Mexican pesos per dollar. And this was about 12.5 pesos 10 years ago. So during that time, the US dollar has appreciated relative to the Mexican peso because now you can basically buy many more Mexican pesos than in the past. So with that, I'm going to pause, and then we are going to shift over to Mr. Coslett.
I'll go down in 3 seconds. 3, 2, 1. Good afternoon, everyone. Let me introduce myself first. My name is Jonathan Coslett. I'm the Chief Investment Officer of a private equity firm called TPG. We started that firm 27 years ago. There was 4 of us at the time, and we had no capital. But over the last 27 years, we've built ourselves into a global private equity alternatives firm. We manage about $100 billion of assets, and we have people all around the world making investments, private, illiquid investments. So as a chief investment officer, my role is to oversee the investment decisions, to oversee the portfolio, to make buy decisions, to make pricing decisions, and to ultimately make sell decisions after we improve companies and make them better. This is new, doing a lecture to an empty auditorium. Of course, it's better for us all to be safe than sorry. And this corona situation is certainly a learning experience for all of us. Look at the equity markets. Yesterday down 8% and down nearly 20% since the all-time highs just 19 days ago. More to come on that later. I'm actually going to put my little thing into something that it doesn't go off every minute or so. So just give me one second on this. Hold on 1 second. Okay. Okay. So this class is about macroeconomics, which is so important to all of us in so many ways. The economy is one of the most fundamental parts of all of our lives. It sets up the environment for jobs, for services, for products that we all depend upon. I'm an investor, a private equity investor. At my firm, TPG, we buy companies. We try to make them better, strategically and operationally. And we started the firm, as I said, 27 years ago. Over those 27 years, we've invested in about 500 companies, about $100 billion of equity invested all around the world. And we've generated a 21% annual rate of return relative to the S&P 500 during that time period has been 7%. And as you all know, the power of compounding, if you compounded 7% annually for 27 years, you get about 3 times your money. if you compound 21% annually for 27 years, you get about 150 times your money. For me as an investor, I always start at the 50,000-foot level. I start with the macro economy. The analogy I like to use is that investing is like being an explorer setting out a journey into the sea. So you can see my picture here of a rough ocean. And the weather, in my mind, is like the macro economy. It's the starting point for the environment of the journey. The skies can be blue and clear, or there can be a hurricane that you don't want to go out in. The ocean is like the industry you choose to explore. The boat I sail is like the company, solid and sturdy or weak and flimsy. And the captain is the CEO, who leads the people in navigating any potential challenges along the way. So today, I want to talk about the macroeconomy through the eyes of an investor, a long-term investor that's thinking 2, 3, 4, 5 years, not 6 months, a year, like many stock market investors. When I put together my slides a month ago for this lecture to address the general macro, there was no coronavirus. The US equity markets were hitting all-time highs, and the US economy was generally considered to be in healthy shape. I'm going to go through my thoughts on the US economy first from the perspective of where we were right before the coronavirus showed up. Then I'm going to layer on top of that perspective the potential, albeit unknowable, effects of the coronavirus in the economy. I'll then talk about some of the secular long-term issues that will persist over the next decade or even more. So let's start from the perspective of where we all stood in early February this year before the coronavirus. What an incredible run we had been on over the last 10 years, but really the last 20 years. GDP in real terms has risen from 13 trillion in 2000 to 20 trillion in 2019. The great financial crisis in 2008 and 9 was very painful, but look at how small it was in the red on the left in GDP terms relative to the entire 20-year time frame. And through this entire time period, only 2 down years of GDP over the last 20 years. Pretty amazing. Jobs have followed, of course. After losing 9 million jobs in the great financial crisis, we have since added 21 million jobs, and at 3.5%, we have the lowest unemployment rate in the last 50 years. For US households, net worth has skyrocketed to over 100 trillion. And even after 10 years, the savings rate remains very strong, providing further room for additional spending or investments by households. The strong economy has led to very strong corporate earnings growth. While revenues have grown nicely, earnings have grown much more, thanks to margin improvement, lower interest rates, and lower tax rates. And as you can see on the chart on the right, corporate profit share as a percentage of GDP has hit generational highs in this upcycle. The strongest tailwind for this growth has been declining interest rates. Very low inflation has allowed the Fed to keep rates very low for a very long period of time. The chart on the left reminds us that the Fed has kept the real Fed rates negative. Real Fed rates, the nominal rate for the Fed funds rate is less than the inflation rate. So it's been negative for most of the last 20 years. So it's actually paid to borrow, given there's been a real negative rate of interest over the last so many years. And of course, coming out of the GFC, the Fed employed new quantitative easing techniques by purchasing bonds in the marketplace to further push rates lower and add monetary accommodation into the system. We sit today with a 10-year Treasury at under 1%, actually 0.5%, by far the lowest yield in US history. And that's all led to this chart. This long 10, 11-year economic recovery and persistent downward trend of interest rates has led to equities booming in the last 10 years. Even with the recent correction due to coronavirus, the S&P 500 is up more than 300%, so 4x from its trough in 2009, and more than 2x its peak in 2007. So it's been an amazing run with interest rates at all-time lows and unemployment at the lowest level in 50 years. But where do we go from here? Even before the coronavirus, there was a lot of anxiety and angst in the minds of investors. Again, let's start from the perspective of where we were sitting in early February, and then I will layer on top of that the potential impacts of the coronavirus. Over the long run, the economy is a fascinating and dynamic mix of secular and cyclical forces. It's like a physics system. The equity markets are a good barometer of the strength of the economy. And if we leave aside for a moment the potential impacts of a black swan like the coronavirus, which by definition are unpredictable, we should be watching for areas in the economy where we detect excesses building, when things start to overheat and get too exuberant. I've said often that this expansion that we've been in feels a lot like that of the 1990s. Many of you probably were either not around or quite frankly very young in the 1990s. But that expansion was long, steady, and had balanced growth. And the only areas of excess seemed to be the technology and venture sectors that boomed in the dot-com boom. The expansion of the 1990s was much healthier than the expansion of the mid-2000s, which was led by excessive mortgage lending, excessive housing buying, and ultimately caused the great financial crisis. So I tend to look at the expansion of the 1990s, not the one in the mid-2000s, to think about how this expansion is progressing and how it might end. And as you can see, even in the very healthy expansion of the 1990s, when the economy turns, even modestly like it did in 2000, where we only had 2 out of 3 quarters with very minorly negative GDP, when that happened in 2001, earnings declined, and at the same time valuation multiples compressed. And as a result, even in that relatively minor recession, equities went down by 50%. The chart on the left shows how incredibly cyclical employment can be. Again, take the 1990s, for example, a long period of strong jobs growth, and then literally on a dime in 2000, with very little warning, unemployment starts to rise, and when it does, the vicious cycle effect tends to kick in and unemployment rises sharply. In most cases before that turn, that very dramatic turn, at every single time, there are few economists or experts predict that this rapid inflection is going to occur. And you can see on the right that the chart there reminds us how quickly the employment picture can change, because it's all about the virtuous or the vicious cycle. It's not as if employment flattens out for a year or two. In fact, every time unemployment has rose by 50 basis points, so from say 3.5% to 4%, there's been a long period of rising unemployment and ultimately a recession. And this is all about the virtuous and vicious cycle effects of activity levels, jobs, hiring, income, savings, credit. We'll talk more about this in the context of the coronavirus. So there's patterns of long cycles. The gray line is the secular trend of growth, which is population growth and productivity growth, and that's the gray line. And population might be growing at 1-ish% in some countries. Here in the United States, it's growing at 0.5%. Productivity might be growing at 2% in some countries. Here it's growing at probably no more than 1%. But if you add up population growth and productivity growth, you get that long-term secular trend, which tends to be something on the order of 2-ish, 3-ish%. But around that secular trend are these cycles, this sine wave. And as we move through the 11th year of this long recovery, we're paying careful attention to the economic data as we ask ourselves, when will an economic rollover come? And as investors, we care about that because when we see economic rollovers coming, we tend to experience meaningfully down bear equity markets. So let's start by discussing the natural cyclical forces in the US economy. The chart on the left reminds us that this has been a very long, the longest, but also a very shallow recovery from a GDP perspective. That's the red line. This should help make this recovery longer and less susceptible to excesses building. And in fact, I think that's where we were just a few months ago. And the chart on the right reveals that the US consumer, who represents about 2/3 of the economy, is continuing to spend steadily and consistently, even 10 years, 11 years into the recovery. Of course, this is all before the coronavirus hitting. But even by late 2019, there was a lot of evidence that suggested that the global economy was slowing. You can see that on the left-hand chart. And it seems we were also starting to see signs that the US economy was also slowing. And while consumers continue to be positive, on the right-hand chart, you can see the consumer sentiment was still very strong a couple of months ago. CEOs were already becoming quickly negative and more cautious, even a few months ago. In terms of corporate profit margins and corporate earnings, margins actually peaked a couple of years ago. But since then, margins have started to compress as wages have started to rise and as input costs had started to rise as well. And earnings had an amazing run in 2017 and 2018, thanks partially to tax reform. But most of 2019 was quite sluggish in terms of earnings growth. So will employers continue to hire as margins compress with sluggish earnings growth? Another important engine for continued growth is investment. So while we had a decent bounce back in investment coming out of the huge declines of the great financial crisis, the growth has been on the weaker side and seems like it was losing momentum. And that's despite ultra-low interest rate. Corporations were more eager to buy back their stock, even at record stock prices, rather than invest in new capacity for growth. Both residential and non-residential investment has been subpar relative to most recoveries. So I'm constantly watching all the leading economic indicators. There's just a handful that I threw up here. Micro data and macro data is coming out every day, every week, and I'm constantly watching those to understand as I see trends occurring. And the above charts, all before Corona, are just a handful of the data points. And you can see that the economy was downshifting to lower growth, albeit still positive. And we'll continue to watch these, now in particular with the new exogenous shock of the coronavirus and activity levels that are going to be affected. But I've tried to put into perspective how to think about when recessions occur. And the good news is they're occurring less and less often. They're occurring once every 7, 8, 9, 10 years, whereas if you look back at the economy 50 years ago or longer, they were occurring every 2 or 3 years. So that's good. But trying to understand when a recession is going to occur from an investment perspective or from a personal perspective is really important. So I've tried to boil it down into a simple framework. And in my simple framework, I believe that expansions end and recessions start generally under any of the following circumstances. The first circumstance, which is the most frequent in US history, is high inflation. Tight labor, tight capacity creates wage and general inflation. The Federal Reserve tries to thwart that general inflation by raising interest rates, tightening liquidity. That stifles demand, stifles investment. It's the old saying, they take away the punch bowl at the party. It's the old saying, the Fed murders every expansion by clamping down on liquidity and raising interest rates. That's the first normal circumstance. The second circumstance is around excess leverage and credit quality problems. So that excess demand that we have in the economy and the easy money creates high and rising asset prices built on high and rising debt levels, and ultimately borrowers realize that they borrowed too much. Credit issues emerge that lead to defaults, that leads to asset write-downs, that leads to banking losses, and subsequently spending and investment has to reset to a new lower level. That's essentially what happened in the great financial crisis. mostly through the mortgage and housing markets. The third scenario that has happened less often in the last 25 years, but was more common in the 1970s, was a supply-side shock. A supply-side shock that raises costs or prices of that key input quickly. Usually that was around energy. Usually that was around oil prices, where because of the sensitivity of the US consumer and businesses to energy prices, if the energy price went up a lot, perhaps because of something that OPEC did, or in 1973, when the US imposed the Arab oil embargo, so we lost all the oil supply from the Middle East, that has tended to create significant input costs problems and start recessions. Again, typically related to energy, and hasn't happened very frequently more recently because the world has become so ubiquitous and supply is so flexible, moving around, and in such ample supply that this hasn't been an issue over the last 20, 30 years, but perhaps could be if you see supply shocks from places like China. And the fourth event that has caused recessions has been an exogenous shock, a black swan event. That could be something like September 11th, that could be a major national disaster like the tsunami in Japan. It could be a major political shock that comes out of nowhere. It disrupts confidence, it disrupts demand, it disrupts investment, and it causes a vicious cycle. So those are the four general areas that I like to think about. And we'll take a little bit of a spin through each of them and talk about them. And again, I'm going to first start by talking about them in the context of where we were a month or two ago, and then we'll layer on top of that what we think might be changing in each of these right now. So first on inflation. It's the most common cause of recessions because it's the most common causes of the Federal Reserve raising interest rates to a level that chokes off investment and demand. You know, globalization, technology, and strong Fed discipline over the last 10, 15, 20 years has been a key factor in breaking the back of inflation that we saw in the late 70s and early 80s. Even in this very strong expansion that we've had, overall inflation has been low, no worse than 2%, very moderate, basically a non-issue. Wage growth has also been moderate for most of the recovery, and that's provided another damper on inflation pressures because wages are the biggest cost that all employers, all companies have. So if wages are moderate, if their rate of increase is moderate, that's really helpful in keeping down in the inflation rate where a company needs to raise their prices because they're feeling like their wages are going up. That's allowed employers to keep hiring those low increases in wages. And, you know, typically rising wages is the key factor that leads to fear of inflation, overheating, and typically that has been the trigger for the Federal Reserve to tighten monetary policy. That seemed to be happening in the fall of 2018, in the September through December time period, and you'll remember that the stock market went down by almost 20%. The Fed was aggressively raising rates in the fall of 2018, but then they got nervous in the beginning of 19, feeling like they were starting to choke off the recovery, and they totally reversed course in the spring of 2019, and they abruptly began reducing interest rates. Even 11 years into a strong recovery, they began reducing interest rates. And last week, of course, we saw the Fed call an emergency meeting and reduce interest rates another 50 basis points. So in the context of coronavirus, the Fed is certainly not worried about inflation, and therefore their bias is to keep interest rates very low. Many economists and market prognosticators are saying that the Fed will reduce rates another 50 basis points at the next meeting at the end of March. So then we'll be down to about 50 basis points remaining. The Fed funds rate will only be 25 to 50 basis points at that point in time. So there won't be much more to go if you're going to have positive nominal rates. So at least for now, this potential cause of a recession, the most common cause of recession, rising interest rates to fight inflation, does not seem to be an issue. One of the most important areas to watch towards the top of a cycle is debt and credit quality. When consumers and companies become exuberant, they buy that bigger house or that bigger car or even the bigger acquisition by the company at ever higher prices with more leverage, and they forget that they may not be able to service that debt if the environment softens at all. Corporate debt on the right is at the highest level it's ever been as a percentage of GDP, higher than at the Great Financial Crisis. Following the Great Financial Crisis, lenders and banks swore off the use of covenant-free loans, loans that had no tests to them. And yet, 10 years later, 90% of all loans now are again covenant-free, no covenants. They seem to have forgotten the lessons from 2006 and 2007 and 2008. Luckily, interest rates are so low that even with that high quantum of debt levels, there's been plenty of room to service that debt. Household debt on the left is much larger than corporate debt, and mortgages are the biggest part of household debt. And the household debt service, you can see the debt-to-income ratio, is actually in really good shape. Coming out of the Great Financial Crisis, banks were much more prudent on how they lent for mortgages. They took loan-to-values down. They raised their standards. They were much more prudent, much more cautious. And of course, with interest rates so low, we're at a point where household debt is actually the best it's been in almost 20 years. So that's really helpful. So on the one hand, we have pretty strong, good household debt and credit issues, and we have weakening corporate debt levels, but still with interest rates so low, the cash flow effects are still pretty good. We are, however, starting to see some early signs of downgrades to debt ratings on the corporate side, to delinquencies in certain parts of the consumer debt, particularly auto loans. So we're starting to see the beginnings of some of the debt issues by virtue of this long recovery and this ever more relaxed lending environment that we've gotten into in the last 2, 3, 4 years. Supply side issues, this one's pretty easy. Most supply side shocks have been due to energy and oil prices, and of course, that's not an issue today. Supply side pressure on oil has eased first because of the shale and the fracking boom and the oil production in the United States over the last decade. And you can see on the right, the consumer spend on energy, consumer spend as a percentage of disposable income, is the lowest it's been in 50, 60 years. And of course, over the weekend, we saw OPEC actually increase their supply of oil in a battle with Russia and perhaps the United States, and trying to see whether they could push Russian oil producers out of business with low oil prices, push U.S. oil producers out of business with low oil prices, because the cost to pull a barrel of oil out of the ground in the Middle East, in Saudi Arabia, is much lower than the cost in the United States or Russia. So if the price of oil is $30 a barrel, which it is today, many producers in the United States and Russia will not make money at that level. So once again, this issue around a supply shock that relates to something like energy or oil, that's not an issue here. Now let's talk about the black swan. So black swans are, of course, impossible to predict, and stocks have been incredibly volatile, declining nearly 20% in just a week. U.S. Treasury, 0.5%. And we're all, of course, still observing and learning and thinking about the potential impacts of the coronavirus as I sit here taping a lecture in front of a big room of empty seats. So that's something that I don't think we would have ever expected. But we should expect some industries to experience really meaningful declines in volume, higher costs of inputs as supply chains are disrupted, meaningful earning declines, deferred investment, and yes, credit pressures for those companies that have high debt and have constrained liquidity. Think about what's going to happen to airlines, to retailers, to restaurants, and think about how severe the implications can be for so many businesses as people stay away, stay at home until they feel safer. The unknowable question is whether the coronavirus is just a temporary, several-month, one-time hit, which, yes, will reduce earnings for some period of time, but then once it's gone, we get back to normal, or could it last long enough to hit earnings, to hit cash flows, to hit liquidities, to become severe enough to create the vicious cycle that creates something much worse? And as you go from a month to 2 months to 3 months to 4 months, the probability that a vicious cycle will happen increases dramatically every month that activity levels stay down. Most economists are looking back at prior pandemics like SARS and trying to draw analogies. You can see on the right-hand side, Morgan Stanley says that the global rate of growth, which averages about 3.5%, which is kind of where it was at the end of 2019, they're saying that, in their base case scenario, the global rate of growth in the world will go from 3.5% to 2%, and then it'll bounce right back and get back to the previous levels. That's kind of the V-shape recession and recovery. But from my perspective, it's fair to say that the ultimate impact on the economy is really hard to predict because we just don't know how long it will last, and we don't know how people's everyday behavior will be impacted. When Stanford University tells its students not to come to class, when Harvard University tells its students to vacate the dorms, there's a lot of strange stuff that's occurring, and I don't think we know today what the behavioral impact is going to be and how long it's going to last. We're obviously all hoping that the new cases will decline over time and we can feel safer and everybody will come back to work. But whether that happens in 2 weeks, 6 weeks, or 12 weeks will make a very big difference into the vicious cycle effect. So let me sort of sum that up. In 2020, we entered our 11th year of the cycle expansion. And while it's very hard to predict when the next economic downturn will occur, this is the framework that I use. Number one, inflation and Fed tightening. That does not appear to be an issue right now. Number two, corporate credit. It's stretched on the corporate side. It's pretty good on the household side. But the virus will have a negative impact, particularly on vulnerable leveraged companies and small businesses. Think about the hair salon, or the dry cleaner, or the local restaurant. So there could be some stress coming that creates defaults, that creates liquidity issues for small businesses and even large businesses that have too much debt. We talked about energy. That's not an issue in terms of a supply shock. But what could be a shock is if the supply chains, particularly China's supply chains, are disrupted enough that corporations can't get the intermediate goods they need to produce something. And then they've got to pay up to get it because it's in scarce supply. They've got to find the supply somewhere. And when they do that, the cost of supply goes up, and that leads to an inflationary force. So that could be something that we should be watching for. But net, I think that the world is big enough, supply moves around enough, there's enough alternative suppliers that it feels like that should not be the major issue or a major issue, but it is something to look out for. And then the last one, exogenous black swans. They usually don't cause the recession unless an economy is already vulnerable. And black swans that have brief durations and pass quickly, the environment usually rebalances back to its prior status. But the question remains, how long will this one last? How impacted will consumers and businesses be? Will volume declines cause earnings declines, cause job layoffs, cause liquidity issues? Will the vicious cycle get started on what was already a slowing down economy even before the black swan? So that's a spin through what I call the cyclical look at the economy. That's looking at the sine curve and trying to figure out when it's going to roll over. Now let's take a look and spend a little more time on the longer-term secular forces that are driving the economy. Things that are 10, 15, 20 years in nature, not 1 or 2 years in nature. As a reminder, this is the chart of interest rates over the last 120 years. And as an investor, I always push myself to remember that the last 30 years have been an incredible anomaly, with interest rates declining massively and continuously from an anomalous peak in 1980. The peak in 1980 was anomalous. It had never happened before. But as a result of that anomalous peak in 1980, we've been on a downward journey past a regression to the norm. Both the absolute level of interest rates and the continual decline of interest rates has been a huge tailwind for asset prices, for equity prices, for the financial industry, for the job that I have in private equity. It's been a huge tailwind, and it's been amazing. But now that we are where we are in interest rates, there really is only no place to go but flat or up. So that's going to make a big difference in the environment, the economic environment, and the investment environment over the next 10 to 20 years. While I can't predict future interest rates with any kind of precision, what I do know is the next 20 years will look nothing like the last 20 years. So as people say, look at history to understand the future, which I very much believe, I know for sure that the next 20 years will look different than the last on this very, very key measure of economic and investment growth. And through the recovery, we saw really aggressive central bank intervention, more aggressive than ever in the past, all around the world. You can see here how central banks were expanding their balance sheets over the last 10, 12 years since the crisis, whether it be the Fed or the European Central Bank or the Bank of Japan or the Bank of China. But we're now 11 years into the expansion, rates are at all-time lows, and central balance sheets have ballooned to $20 trillion. That's $20 trillion of purchases that they made that injected money into the economies of the world. And yet we're still seeing continued accommodation all around the world. So on a secular basis, not a cyclical basis, on a secular basis, have the world's central bankers systematically become more proactive? Have they become addicted to this drug called super low interest rates? And are central banks over-engineering and creating artificial conditions in the economy that are not sustainable? This one, I don't know whether Professor Duggan and you guys have talked much about. I'll just spend a second on negative interest rates. So today there are $16 trillion of debt with negative interest rates. So in Denmark, if you want to buy a home and you want to borrow money from the bank, you can repay less than you borrowed, essentially implying a negative interest rate. Essentially, the bank is paying you to take their money. We could have a whole lecture on why this is happening and whether it makes any sense. But do any of you understand this phenomenon? One of the things that I always say is just go back to logic and intuition. Does this make sense that you go from paying to use capital to have someone else pay you to use their capital? That implies that that bank in Denmark is really happy to give you $100 and get back $98 or $99. That says a lot about what the implied view of economic growth is and returns on capital over the next 10, 20, 30 years, at least for that bank in Denmark that's willing to do it. And I would encourage you guys to spend a session on this because it's so fascinating and it's so unintuitive. The next big secular trend that we're going to have to deal with over the next 15, 20, 25 years, it's all about demographics. And demographics always drive a big part of economic conditions. And one of the most inextricable factors is that we can predict is an aging population. Longer lifespans and fewer babies, meaning the world is getting older. And unfortunately, that means fewer workers are supporting more dependents. And that means we need to probably rethink the state of taxes, entitlements, and perhaps ultimately much lower sustainable growth. Again, growth fundamentally is the sum of population growth and productivity growth. And population growth is coming down. Another big secular issue to think about, particularly in the US economy, is the US government has run up the highest debt level as a percentage of GDP we've seen since we had to make tanks and artillery for World War II, despite being in the 11th year of a great expansion. We're running a $1 trillion deficit driven by aggressive fiscal policies that did not end as the economy continued to boom, and increase in military spending. While these are tolerable in the short term, they are going to ultimately limit the United States' flexibility and fiscal spending power, and it's an issue that will come back and be a problem in 10, 20, 30 years. China. Let's talk about China and its longer-term implications on the global economy. Over the last 30 years, China has an unprecedented economic transformation. And now it's the second largest economy in the world, but it accounts for a third of all the GDP growth in the world. A third of the growth of the world is just in the country of China, given their relatively high growth rate versus other countries and their size. We've seen a massive growth in debt over the last 10 years in China, which has helped fuel their spectacular growth. But on a longer-term basis, will China's huge debt load strangle its economy? Will we get to the point where the borrowers can't repay their higher and higher debt that they've been getting so easily from the banks in China? As a matter of fact, these central authorities in China have been pushing those loans to create the growth that's occurred, to build the bridges, to have people buy more houses. That's all good up to a certain level, and you can see that the increase and rise of debt in China has been incredibly high over the last 15, 20 years. And of course, even before the outbreak of coronavirus in China, we were already seeing a real slowdown in the Chinese economy. You can see that on the right. That's before the coronavirus. And now fighting the immense challenges of the coronavirus, if the Chinese economy slows from 6% to 0 or 2%, or has no growth in 2020, will that be an event that triggers the next global downturn, given how big China is in the world's economy, how it's one of the biggest suppliers and also one of the biggest buyers of other people's goods. So the rise of China and its size and importance in the world economy is something that we got to think about. So we all should be not just macroeconomists on the US, we should be macroeconomists on China as well. Again, another long-term secular issue is productivity. I've mentioned this already. It's the most important fundamental factor for a healthy economic growth. And in the US, we had great productivity in the 1990s. You can see we topped out at 4% when the internet was introduced. Massive productivity growth when the internet was introduced. But over the last decade, despite the continued boom in technology and innovation and new things that we're seeing every day, it appears, at least from the official statistics, that productivity has been quite anemic, 1%. Doesn't make a lot of sense. Doesn't feel like that's happening. Mark and I have talked about this many times. Maybe there's measurement issues. Maybe, maybe there's other sort of transient factors. But if these stats are even directionally correct, something strange is happening, because despite all the good technological innovation we've had, it has not been leading to an increase in output per hour of labor, per person of labor. Speaking about technology, what a boom we've had since the introduction of the internet in particular, but the last decade. It's fueled immense growth, immense innovation. But we also got to think about the other side of it, which is some of this technology boom in software, in automation, in robots, in AI. It's going to make it really hard for certain types of job creation. You guys are gonna all spend the next few weeks at least with just your computer screen and sort of virtual teachers. So remember that old saying, the introduction of cars was great for everyone but the horses. Are we humans the horses? And in this new world where technology can replace physical labor, how will economic policies need to change? A lot of this is building up to this huge issue that's out there socially that we're all feeling both explicitly and implicitly, which is the issue of inequality. So despite this incredible growth over the last 10 years, inequality has never been worse. The left-hand chart shows that economic growth has indeed raised the real incomes of the bottom quartile of the world population, but the middle has fared very poorly. Of course, the big winners have been the top of the pyramid. But this problem has fueled has fueled growing populism, and it's led to surprising things that were never expected to happen, like the election of Donald Trump, like the vote for Brexit, like the rise of Bernie Sanders, who embraces democratic socialism. This is all a result of a sense of inequality that's pervasive in most developed countries in particular, and increasingly all over the world. And that is leading to anti-globalism. It's feeding into an anti-globalistic sentiment, and that's tangibly now impacting global trade. Globalism has been one of the great drivers of progress and economic growth around the world for the last 100 years. And there's been incredibly uniform buy-in to the concept of free trade, as evidenced by the massive reductions in tariffs over the last 90 years that you can see on the left-hand chart. But the Trump administration has thrown all of that out the window. And global trade, as a result of the tariffs, of the stress and the tensions, of the trade negotiations, of the trade wars, global trade has ground to a halt. Of course, lastly, again, on a secular basis, not necessarily on a specific cyclical basis, but on a secular basis, we have incredibly high political dysfunction in the United States and in many places of the world. The views of the right and the left have never been more extreme. There seems to be no place for those in the middle and no way to create constructive political compromises to solve problems. So in the short term, with such extremes between Bernie Sanders on the left, Donald Trump on the right, Joe Biden somewhere on the middle left, it seems like this election will determine a lot about the fate of the US economy and markets over the next 5 years. But this broader issue of a highly polarized government in the United States poses a different, longer-term secular issue that we're going to have to deal with. Okay, so those are some of the secular issues. We did cyclical, we did secular long-term issues, things to think about on both the short and the medium long term. So I did something like this at our annual investors conference, and in the audience we had about 1,000 representatives from some of the biggest groups in the world, from CalPERS and CalSTRS, who are the pension funds for the California teachers and firemen, sovereign wealth funds like the Sovereign Wealth Fund for China. And we had these folks in the audience, and after going through something like this, again, this was before Corona. This was 3 months ago, so before Corona, markets hitting all-time highs, economy feeling very good. We asked the investors at our conference, when do you think the US will experience its next economic downturn? In 2020, which at that point was still a few months away, 2021 or after. And you can see that most of our investors anticipated a recession in the next 1 to 2 years. So 77% expected a recession in 2020 or 2021, before the coronavirus. What do you guys think? Think about that. Now let's translate that into markets and equities, again, from the investor's perspective. That chart on the left, what an amazing run we've had over the last decade prior to the last couple of weeks. And the chart on the right, let's examine the chart on the right. So that's the 10-year rolling annualized return of the US stock market. So you can see that when things are going well, on a 10-year basis, the returns average 15% for the prior 10 years at the peaks. You can see that in the peak in 1960. You can see that in the peak in 2000. You can see that at the peak in 2019. So 15% annual rate of return on a 10-year rolling basis. That's pretty close to where we were a few weeks ago. We were up 30% on a one-year basis in 2019. But it also reminds us that, put that in the context, when you take the average over the last 20, 40, 80, 100 years, the stock market has returned 8%. So the peak is 15% a year on a 10-year basis. The average over time is 8%. And the lows are about 0% for 10 years. We had 0% for 10 years in 1980. We had 0% growth for 10 years in 2008, 2009. So this is just, there's nothing fundamental about this. This is just empirical evidence. But what is fundamental about it is the way human behavior works. Human behavior works with optimism on the upside, with pessimism on the downside. The virtuous cycle works with things getting better, leading to something better, leading to something better on the upside, and the opposite. When things go down, jobs get constrained, income gets constrained, investment gets constrained. So this leads me to ask all of you, for the next 10 years, what do you think the stock market will do, equities will do, over the next 10 years coming off of where we are today? That's a really interesting question. But we shouldn't be surprised at what we're seeing in the markets right now. The stock market grew 30% last year, 30%. So it's now down 19% as of this morning. But it's down 19% after being up 30%. We've had an incredible run in equity values. Valuations are very high. And we've had 11 years of equities going up, 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 because interest rates have been going down, 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 and because the economy has been growing. At some point, credit issues have to start occurring. And then just when you least expect it, when everything is going really well and people are very exuberant and very bullish and very complacent, something totally unexpected comes, like 9/11 or like the coronavirus. And that's where we are today. Really interesting stuff in the short term, but also really interesting things to think about on the long term, around inequality, around the social effects of that, around how the government reacts to that, and how business reacts to that. That's all I had for this morning. Thank you, guys.